Hey there, welcome back to topic 4 of stock trading for beginner series. Today we'll look at another useful technical indicator, the relative strength index, also called the RSI. This is arguably the most popular technical indicator amongst new and beginner traders, partly due to its simplicity. So first, what is relative strength index or RSI? Simply put, it's a momentum indicator that aims to show if a stock is overbought or oversold. It works by measuring the speed and change of price movements of a stock. It's also called the momentum oscillator because the RSI oscillates between 0 and 100. It was developed by J.W. Wilder and has been around since the late 70s. Before we see how to apply this in real trading, let's quickly look at how it's actually calculated so you get a complete picture. Sorry if you're not a math enthusiast, I'll keep it brief. The formula for RSI is 100 minus 100 over 1 plus RS. The key here is the RS or the relative strength. It basically looks at how many days over the specified time frame did the stock finish up or down and takes an average of the total points gained and then divides that by average of total number of points lost. The specified time frame is always 14 days as suggested by J. Wilder, who developed this formula. However, some experienced traders tend to use different time frames. Well, this is just for your information. You don't have to do any of these calculations in real life. Your trading software will do it automatically, but it helps to know. Now, with that out of the way, let's get down to some real life scenarios and see how it can be used to generate potential trading signals. Let's pull up a daily chart for Amazon, because why not? I always leave the RSI time frame at 14 days. As a general rule of thumb, when the RSI is above 70, the stock is said to be overbought, and when it's below 30, it's said to be oversold. Here, you can see the last overbought signal was on 1st of Feb, and last oversold was around 9th of November last year. Notice how the price is moving in sync with the RSI? Well, while it's not perfect all the time, it can give you an overall sentiment of the market, suggesting if the stock is due for a pullback or run-up. You can change the time frame of the chart depending on your trading style. So if you are a scalp or a day trader, you probably want to look at a 5-minute price chart and the RSI changes accordingly, giving you a fair idea of where the market is headed. Traders often look for buying opportunities when the RSI shows oversold and look to sell when RSI is entering the overbought territory. But it's important to always use this strategy in tandem with other indicators to confirm the trend. For example, a bullish reversal candlestick pattern if you are buying. Here's a quick tip. If you see RSI entering the 30 mark, you could wait for a reversal at 40 RSI before buying and set a stop loss at overbought level here around 30. That way you're protected from any false breakouts. Similarly, if you're looking to take profits, you could set a trailing stop loss when the RSI starts crossing 60. That way you can maximize your upside should the stock price move further up. But remember, RSI is not a magic formula. It's merely telling you how the market is behaving right now in comparison to the past. As with anything, RSI also has a limitation. We know markets are bound to volatility, so sometimes RSI can oscillate too many times without really giving clear signals. And that is where an RSI divergence can help tune out the noise, as it's considered a bit more reliable than the normal RSI. Let's look at an example of RSI divergence. Notice how the price and RSI here are moving in opposite direction, unlike the normal RSI, which is mostly in sync with the price movement. This is precisely why this pattern is called divergence. We can look for potential signs when an RSI is starting to weaken, like in this example, while the price has not yet weakened. So when the price moves up, but the momentum is starting to slide, it may be an indication that the reversal is due, like in this instance. Basically, RSI divergence helps with reversal patterns. Traders use this to exit if they have a long position or enter if they're looking to go short? Well, it will make sense when we look at the types of divergence. There are two types of RSI divergence, regular and hidden. But since this is for beginners or new traders, we'll only focus on regular or the standard divergence in today's video. A regular divergence can be bearish or bullish. Let's look at some chart patterns. Now, here is the price chart, and this is RSI. Notice how the price is moving downwards, making lower highs, while the RSI is moving in the opposite direction, making higher lows, suggesting the momentum to the upside is starting to build up. This is a bullish regular divergence. In a bearish regular divergence, price moves upwards, making higher highs, while RSI moves downwards, making lower highs, signaling an opposite trend. So divergence basically tells you a potential reversal may be coming in the future, but it obviously can't tell you exactly when. Let's see a real life example quickly. Here you can see a lower low forming in the market and higher highs are being formed on the RSI chart, and surely enough the markets then reverse to the upside. Now in hindsight, it's safe to say the divergence set actually worked out, giving some obvious entry levels and stop losses like here and here. One thing to bear in mind is that divergence setups are pretty rare and therefore are considered more reliable than normal RSI patterns such as overbought and oversold. Well, that being said, no setup is going to work 100% all the time. It's not going to print you money. However, this can confirm potential trend signals when used in tandem with other techniques. Essentially, you can build your own trading theory and a strategy by using these indicators. And like I keep saying, remember to always backtest your strategies before using them in live trading. I hope you found this useful and see you very soon in the next one. Take care.